So have you thought about tax returns and home ownership and what are some benefits of the taxes if you own a home? Today, we've got an expert to help us understand that. I'm Theresa Wellman with homeownerexperience.com, your local San Jose, California realtor. And today I have Scott Perring here to help us understand some homeownership and tax topics. So Scott, can you introduce yourself?
Definitely. Thanks, Theresa. So my name is Scott Perring. I'm the founder and CEO of Seek First. We are a small tax and financial planning business here out of Campbell, California. And we specialize in helping people with any significant financial issue they're facing. Sometimes it's a tax strategy or an investment strategy or retirement plan. We have a process to give them a breakthrough about that and point them in the right direction. So I really hope today is insightful and informative and transparent and helpful for you as you think through your tax strategy.
Perfect. Thanks, Scott. I know we're going to have some good nuggets today, so I'm looking forward to it. So we've got several different questions we're going to cover, and then we'll give you at the end of the video information if you want to contact Scott for more details, to ask questions, have a consultation meeting. So Scott, I work with a lot of home buyers. Obviously, that's my business. On some first-time home buyers who really just don't have an understanding of how income taxes and home ownership change once you buy a home. And so can you talk a little bit about how buying affects your tax return?
Absolutely. And let me just start by saying taxes are complicated. So it's no surprise that a lot of people don't have a proactive strategy in this field, right? I see folks every single day come in who are paying 40% or 45% or sometimes over 50% in tax when you include California. And it's so complicated to understand, to comprehend. It's always changing. There's the IRS and there's Franchise Tax Board. And so I get it. And I hope some of these nuggets today will move you in the right direction. As far as home ownership, the short story is when you're a homeowner, you're open to a whole slew of tax strategies that you don't have as a renter. So specifically, there's mortgage interest deductions. You can deduct your HELOC interest. You can deduct PMI if you're paying that. You can deduct property taxes and state tax. There's a lot you can do there, and we'll talk about a few other things as well. But bear in mind that it's only helpful if you're itemizing deductions on your taxes, which means you're not taking the standard deduction. This year for married filing jointly, the standard deduction is about $27,000. So you need to have more than $27,000 in itemized deductions to get any benefit from that. And itemized deductions are those things I mentioned, as well as state tax, so California tax counts and sales tax, a few other things wrapped in there, but that needs to be over the 27K threshold to take advantage of those opportunities.
Perfect. Understood. Okay. So what are some strategies for homeowners that can help with their taxes?
So I'd say number one, having a proactive plan, coming in with me or someone else, lay it all out and say, what am I already taking advantage of? And what are the other strategies that are out there that weren't so clear or so readily available? The easy ones that come to mind are if you have a business or if you rent a portion of your home, it opens you up to a whole plethora of new deductions that you can take. So things like the home office deduction, business use of home, a rental. If you rent, a room or an ADU, you can deduct a portion of expenses, and the expenses are far-reaching. So it can be your mortgage payment, it can be utilities, PG&E and other utilities. It could be internet, cell phone, maintenance. So landscaping and house cleaners, sometimes a lot can go in there, as well as the business equipment. That's huge. If we can make a case for a consulting business or some work at home, or if your spouse has a business, or if you rent some of the property, it really opens you up to a lot of deductions that are significant. They're 5 or 6 figures for a lot of folks coming off the top.
Wow. Yeah, that's pretty amazing. And it's something that maybe not everyone thinks about. So I appreciate you sharing those tips. That's great. So are there common misconceptions about owning a home versus and combined with income taxes? Or, what do you see when you meet with people?
Yeah, I see there's confusion often and, kind of bad news out there as far as what's deductible and what's not. So I just mentioned if you have a home business or you do some work from home, or if you have a rental in your home or a portion that you're renting out, then it opens you up to all that. Without that, you can't use it, right? So if you're just a W-2 employee and you can't make any case for this, then these are not available to you. Now, there's ways around that to, legally and ethically open you up to that, but a lot of people don't understand that. So, they think a home office deduction could be for everyone, and we need to explain, no, it's really only if you have a business use or a rental use. So that's one. Another is what part of improvements are deductible and what's not. So the IRS distinguishes between capital improvements on your home and repairs, and capital improvements are deductible and repairs are not. Right. So capital improvements are things like a new roof, a swimming pool, an addition, a kitchen remodel, new landscaping, all that's clearly adding to the value and use of the home. What's not deductible are repairs or replacing things, or most paint isn't deductible. It needs to show that it is an improvement. It's increasing the value of it. And with these improvements, you don't get the deduction right away. So if you have a business use of home, you can, and say you put on a new roof, the roof needs to be depreciated over 27 and a half years. Which means if the roof costs you, 27 and a half grand, you can only take $1,000 a year as a deduction off this year's tax return. But you still want to track all your capital improvements, because when you eventually go to sell, all of those come off the top and increase your basis. So your capital gains are minimum. So it's super important to keep records. I mean, ideally receipts and invoices and, transactions and Home Depot receipts and all of that, so that you can make a case for, hey, here are all the capital improvements that you placed into the home.
Okay. So just to clarify, you're distinguishing if you have a business or a rental, you can take some of those improvements each year, a small portion, right? If you don't, you're still taking advantage of the capital gains tax when you deduction, or what is it called? The adjusted basis when you do sell.
Exactly.
Yeah. Exactly. So keeping
you just don't get a benefit this year, you're getting the benefit in the future when you sell.
Yeah, exactly. So keeping the records is really critical for those days, right? Keeping on track of it today as it's happening, so you can capture every possible dollar in that process, right?
Absolutely. So that's best case scenario. Now, in reality, people come in who've had their home for 15 or 20 or 30 years, and the records are questionable, right? There's some pictures, there's a few invoices, maybe for the major remodels, but not the smaller stuff. So we go through with them, look through bank statements, create a spreadsheet, and list it all out. Best case scenario, you do it at the end of the year. So like my wife and I, at the end of the year, we look back and say, what did we add to the home? Okay, it was the deck this year, and the landscaping, and the pavers, and the solar, right? And we chart that out per year in a spreadsheet. But if you don't have that, you could still make a good case for it. It's still legit. It's just a little bit of extra work to, make a strong argument that here's how much you paid for the different improvements.
And I might say it's a lot extra work.
Yeah.
It can be a lot. Yeah. So
well, that's why people come to us, right? Because they're like, help me. I know this is important, but I don't know how to benchmark it. Like, help me fill in the gap. Yeah.
Perfect. Yes. I think we've covered kind of some of the initial questions that I had. What other tax strategies have you seen that homeowners could benefit from?
There's several. So let's see. When you're selling, you get a $500,000 capital gain exclusion. As long as you're married and you've lived there 2 out of the last 5 years, you get that exclusion, right? So you bought it for $500K, you sell it for $1 million, that's $500K, and you don't owe any tax on that. So that's a big deal, and that's a big part of the calculation when we're helping folks know how much capital gains tax they're going to owe. Outside of that, other tax strategies that are available to homeowners and others that I've seen that we work with all the time are maximizing all the deductions for your home. So we mentioned mortgage interest, home office, car mileage. If you rent the home, some folks don't know you can rent your home up to 14 days a year with no tax owed. So we have some folks who have a vacation house or a beach house. They could rent it, 14 days for like, $5,000 or 10 grand, and none of that is reportable on their tax on their income tax return because it's
Wow.
less than 14 days. So that 14-day is really important. It's an important exclusion. Other tax strategies are maximizing your investment contributions. So obviously maximizing 401k accounts, but also RSUs, restricted stock units, or options, or ESPP accounts, or deferred comp. And then if your spouse has, an IRA or a SEP IRA, you can also do backdoor Roth IRA contributions. You can do Roth conversions. There's lots of strategies to get as much money. We call it getting it above the line in tax deferred and qualified accounts. The government limits how much you can put up there, but you want to make sure that's maximized each and every year.
Got it.
That's a big one that normally by the time folks come into us, they put some thought into this, but there's normally the next level planning that we can add to the table.
Yeah. That sounds like so many different strategies, and probably for the normal homeowner or, employed person, like high level, right? So that's where having some assistance to strategize on those can be really helpful, like your company provides.
Yes, for sure. And the other one I'll mention is maximizing your investments from a tax perspective. Okay. So things like minimizing capital gains, making sure it's all long-term. So you've held the positions over a year. Minimizing ordinary dividends and making sure they're qualified dividends. So going in strategic funds that pay qualified dividends. So it's capital gains rate, not ordinary rate. Okay. And then putting tax efficient investments in your non-retirement accounts, as opposed to the investments you put in your retirement accounts. So it's an allocation. It's like, hey, you could own the same portfolio, but which investments should live in the 401k or in the IRAs versus which one should live in the joint account or the brokerage account or the trust account, where you pay tax every year, you get a 1099 every year. Making sure that split is optimized is often something people don't think about that is valuable to them. Yeah,
for sure. So putting that, I feel like some of those are advanced level. Putting that into perspective, where do you see people asset-wise or age-wise getting to a point where a lot of these things come to advantage? Like I can imagine a first-time home buyer maybe doesn't have as many assets to be taking advantage of all these different things, but do you see a point where it makes sense to really take advantage or to go to the next level?
Yeah, I would just keep it simple. And if anything I said, piqued your interest, I'm happy to have a conversation and at least point you in the right direction. Because while the numbers may be bigger in your, 40s, 50s, 60s, 70s, the strategies are available to everyone if you qualify, right? So it makes sense to get on a good path in your 30s and 40s, even if the numbers are smaller, to take advantage of these, available tools that are out there for everyone that are totally legit. I mean, we don't do anything wild and crazy. We know there is a line ethically, tax-wise, and we always stay on this side of the line. But it's our job to show you all the opportunities, right? It's like, here's the 10 things you could do. And then you get to choose, do you want to do all of it? Do you want to do some of it? Or do you want to implement none of it? It's totally your prerogative. But at least being educated on here are the tools that you can use I think it's critical, wherever you are. Just making sure your tax strategy is dialed in. I would say most folks we meet with, their tax strategy is probably like a 5 or 6 out of 10. I mean, it's not terrible. They might have an accountant, they might use TurboTax, but they don't normally know about all the tools, right? And so getting those laid out is, it's helpful for folks at any level.
Perfect. Okay, great. So if viewers would like to reach out to you, like you mentioned, what would be the best way for them to do that?
Yeah, I know you'll have my contact info in there. You give me a call or shoot me an email. We're here in Campbell. We do a complimentary 1-hour meeting to lay that all out and give you some of that analysis I mentioned. And then at the end of that, the question is, are we a good fit? Is there something we can help with long-term or not? And, sometimes it's just helpful as a kind of a power session. We do complimentary, or sometimes folks want our help, moving forward, and we're good either way. But yeah, I just encourage you to get some help from me or someone else to align that tax strategy with your values and your goals, because again, it's such a major issue. I mean, folks are paying 40%, 45, 50% of tax, and it's painful. And it's unfortunate that the code is so, tricky and unclear that it's not straightforward. So I believe it's worth the conversation,
Yeah, absolutely. Okay, so we'll definitely put the contact information up on the screen and in the description below, so you can reference it later and reach out directly if you have any questions. So in closing, Scott, anything else that you feel that we missed that we should touch on before we say goodbye?
I would say it's tax time. So this is the time a lot of people are thinking about this. We're all well into our tax prep season here. You might have heard that the tax deadline due to some of the flooding in California in the last month has been pushed to May 15th. So we all have a bonus month this year, kind of like during the COVID stuff, there's some bonus time. So a little bit of extra time to look at these strategies if that's relevant for you, and make sure you're dialed in for 2022 and then a plan for 2023 going forward.
Perfect. All right. Well, thank you so much, Scott. It's been a pleasure learning from you today and empowering us with a whole bunch of different options to improve the taxes and make it better for us going forward. So thank you.
Great. You're welcome. Thanks, Theresa.